Good evening. The war between America and Iran has been continuing for over 3 months now, and it doesn't seem to show any visible signs of coming to a complete end anytime soon. Dialogue between America and Iran has been on again and off again. The big question now is the ceasefire, which has been in existence and by and large has been holding well for the last couple of months almost. How long can that be extended, and can there be a permanent peace between America and Iran? And more importantly, what about down the line consequences for countries like India? The rupee is touching 95 to the dollar. Fuel prices have been hiked domestically 4 times in the last 2 weeks. All of this is causing pressure on the current account deficit. Joining me now for this Times Now Global Exclusive is a very special guest. Mr. Mark Zandi is the chief economist with Moody's Analytics. Thank you very much, Mr. Zandi, for speaking with us. You said recently that Donald Trump has just about a week or so to strike a deal with Iran before America starts facing a real problem. What is this real problem that you are alluding to which could hit home if this permanent peace or this agreement cannot be arrived at in the next few days?
Well, this goes to obviously the Strait of Hormuz, opening up the strait, getting global oil tanker traffic moving through it, getting production back up, and getting prices, oil prices back down. All that has to happen, if not in the next week, in the next few weeks, next couple of months, because it's doing a lot of damage to the higher oil prices are doing a lot of damage to the U.S. economy and of course the broader global economy. So there isn't a whole lot of time here. That's the point of the week, but maybe it's 2, maybe it's 3, maybe it's a month or 2, but we don't have a whole lot of time because if we don't get this straightened out, oil prices will move higher, and that'll be the fodder for an economic downturn or recession.
You've also suggested that crude prices going above $125 a barrel could become another marker, a tipping point for the U.S. economy, possibly slip it into recession. If that were to happen, and right now we're looking at oil under $100 a barrel, are we looking at the possibility of some kind of a localized recession in the U.S., or are we looking at a global recession? Because clearly this is going to have down the line consequences.
That would be $125 oil for a couple, 3 months. That would be consistent with a global economic downturn, certainly enough to push the U.S. economy into recession. And actually, the U.S. economy can navigate all of this more gracefully than much of the rest of the world. And that's because the U.S. produces a lot of oil as well. We in the U.S. Consume and produce about 20 million barrels of oil a day. Most of the rest of the world obviously consumes a lot more than it produces, if it produces any oil at all. So when prices rise, it does a lot more damage. So the U.S. is among the most insulated from all this. So if the U.S. economy is going into recession, hard to imagine the rest of the world won't also be following close behind.
Is there any specific level at which you're looking at oil prices? I mean, OPEC has just announced a few days ago it's going to increase its production as we go along. Right now, like I said, it's well below $100 a barrel. But are you looking at any specific band or window in which oil is trading in the next few weeks and months?
Yeah, we're at just under $100 a barrel right now. If there is no deal, then I'd say a month from now, if you told me prices were close to that 125, I'd say that sounds about right to me. So, maybe not quite there, but that's kind of the ballpark. What's going to happen is that the world is running out of oil inventory. I mean, the world has been cushioned by the fact that there was a lot of oil in inventory coming into the war. We've drawn that down now, and we're getting to a place where there is insufficient inventory. So we're going to see physical supply shortages, jet fuel, diesel, gasoline. And when that happens, that's when I expect we'd see much higher prices. So is that in the next week or the next month? I'm not quite sure, but that's in the not too distant future if the strait doesn't get reopened here soon.
So the last time we had this kind of economic damage was way back in the 1970s when the oil prices went up again above $100 a barrel. At that time, there was both a inflation problem as well as stagnant growth. Are we going to go back to the days of the 1970s where we see higher inflation and also stagnant growth?
Well, we're there already, right? Stagflation, certainly in spirit. Growth is slowing as a result of the higher oil prices and other commodity prices. And of course, inflation has really picked up quite a bit. It's not quite what happened in the 1970s and 80s. In that period, that was a virulent form of stagflation. Inflation expectations also increased, and inflation became much more entrenched, more persistent, required the Federal Reserve and other central banks to tighten monetary policy a lot more aggressively. We're not there yet, but we're headed in that direction. Inflation is up. Inflation expectations have picked up, but so the 1970s are a harbinger of what could happen if we don't settle this in the not too distant future.
And we've seen this every time there's a major geopolitical crisis, whether it was in the 70s, the oil crisis you were referring to, the housing crisis in the early 2000s, the dot-com bust, etc. Every time this happens, the dollar gets strengthened. And again, this time too, the dollar has been strengthened. Why does that happen? And what do you think that means for emerging economies like India?
Well, historically, the U.S. Has been a safe haven, right? When times are tough anywhere on the planet, including here in the United States, capital flows into the U.S. The investors feel that the U.S. is a place where if they put their money, it's money good, that they'll get their money back with interest. And that remains the case. The U.S. remains a safe haven, although, over the past year, two or three, that safe haven status has come under some question. I mean, as the U.S. has moved away from the rest of the world through higher tariffs and export restrictions, investment controls, visa actions, a lot of different ways the U.S. is pulling away from the rest of the world. And now the rest of the world is pulling away from the U.S. That safe haven status is under pressure. It's diminishing. And I think that means that, when you get into these periods of crises, when a risk-off environment, when people are nervous and scared, we might not see the same capital flows into the U.S. as we have historically. And obviously, on the other side of that, EM currencies will hold up better, and that's what they've done here in the current crisis, the current war. EM currencies have held up better than has been historically the case when we've gone through similar kinds of events.
But what about the Indian currency, the Indian rupee? It's right now the worst performing currency in Asia. It's touching 95 to the dollar, and experts say it could even touch $100 to the dollar very soon. What are your thoughts on the Indian rupee?
Yeah, and that makes sense, right? You know better than I, but the Indian economy is very dependent on oil, particularly from the Middle East, and this has been highly disruptive to the Indian economy. So it's not surprising that the currency would be under more pressure than other parts of the world. So not surprising. Hopefully this does come to an end relatively soon. We can open up the strait, get oil flowing again, and India can get its footing again. But as long as the war is raging, as long as the risk of oil prices going higher is there, I think the Indian currency will remain under pressure.
There's a lot of debate going on here in India as well, in two schools of thought. Some say that the RBI, the central bank, should allow the rupee to fall freely. If it touches 100, 120, so be it. Geeta Gopinath has been making that point quite forcefully. On the other side, there are folks who are saying that the RBI should support the rupee and not allow it to keep going in this free fall. What are your thoughts on the central bank intervention to try and support the rupee, support the currency?
I don't have a strong view there. I mean, my sense is that all else equal, it's probably best to let the market work its respond and adjust to the market conditions that exist. I don't know that I'd be too focused on that, but I don't really have a strong view on that at this point. No.
What about the overall picture itself for the Indian economy? We've seen a lot of FPI and FII money flow out of the Indian markets. You mentioned a moment ago that India imports about 80% of its crude oil, therefore the pressure on the currency. What's your overall outlook, economic outlook for the Indian economy?
Yeah, well, I mean, I think you said it all. I mean, this really needs to get settled quickly. I mean, if it doesn't, it's going to do much more serious damage to all economies, including the Indian economy, because it is more exposed. So hopefully this gets done in the next few weeks. Otherwise, I think recession risks will rise pretty significantly.
So this is, of course, around what has happened, the latest, the Iran war. But over the last 5, 6 years, since the pandemic, We've had stretched public finances, high debt. Of course, countries around the world have sort of printed money and got their way out of it. But now you have high fuel prices and there is instability in the Gulf. The Strait of Hormuz is shut. How much pressure do you think that's going to put on public finances, particularly in developing countries like India, where fuel is subsidized, food is subsidized, there are massive welfare programs? How do countries like India deal with that?
Yeah, this is going to be a ill effect of this war that's going to play out over a long period of time. I mean, even coming into the war, fiscal conditions were very stretched. Obviously because of the pandemic and the costs that imposed on many governments around the world. So the fiscal situation of many countries is under a lot of pressure, including developed economies, European and U.S. And so this is a global problem that will only be exacerbated by, the subsidies that are being provided now to help cushion the blow from the higher oil prices and the war effects. So I do expect that this will be something that governments will have to deal with, on the other side of all this, and it will take a lot of time and hard work to get it done. And it does raise the risks that, at some point here in the not too distant future, we'll have another potential set of crises, and that's around the fiscal condition of many countries that's already very fragile, and the war is making it even worse.
One last question, Mr. Zandi. Between the wars, you've got supply chain disruptions, rising energy prices. Are we now entering a new economic era where countries are going to prioritize their own local needs, their own strategic security over globalization, over global efficiencies, and so on? And what may that mean, again, for both developed and developing economies?
Well, that's what's happening. That began with the pandemic. I think that strategy was reinforced given other geopolitical events like the Russian invasion of Ukraine and now the Iran war. I think governments are increasingly focused on kind of their own national security interests and issues and becoming more insular. And it is a sea change, between World War II and right up through up to right before the pandemic. The world was globalizing. We were becoming more integrated, and now we're moving in an opposite direction, and that appears to be the case going forward.
All right, Mark Zandi, Chief Economist with Moody's Analytics. Thank you very much for joining us here on Times Now. Thank you for your time. All right, on that note, we'll take a quick break here on the program, but news and updates continue right here on the other side.